Hi everyone, this is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's joining us from Texas. He has over 30 years of experience in the oil and gas industry. Thank you. He runs Energy Prospectus Group, which is a group of investors looking to outperform in the oil and gas industry. Thank you for joining us, Dan Steffens.
Yeah, hi Jason.
Now, Dan, I want to talk about the supply-demand fundamentals of the oil market. Last time you and I talked was a couple months ago, and the oil market just seemed to keep going down and down, and we had a lot of silly Wall Street analyst calls. You know, one of them, Dan, was from, I forget the analyst's name, but it was a Forbes article, and the guy was like, the oil price will never go above 50 again. They were just jumping on the bandwagon. What's your opinion of what's changed in the fundamentals of the market?
Well, one thing I'd like to say is that everybody that always says this oil cycle is not like all the others that went before it, that oil prices will never recover again. Well, that's what they always say, and then they always recover again. I mean, it's happened every time. I mean, think about it. Eventually, oil has always returned to the trend line, and I think the reason why is that oil's too important. I mean, maybe second only to food. Oil is the most important commodity on this planet. We need it for our standard of living, and it just cannot stay below a reasonable our finding and development costs for long, and capital is not going to go into investing in oil and gas drilling and development unless it can get a reasonable rate of return. So that price is probably north of $65, $70 now. And so I think oil prices got to get back to that eventually, or else you're just going to have a continuing decline in your supply, and then you're in a tough fundamental situation where they'll be screaming about shortages instead of screaming about gluts. So,
Yeah, and there wasn't even that big of a supply glut. I think I was doing my own research, and I read a number of analyst reports, and this enormous supply glut that we heard on CNBC and Bloomberg, it was only about 1.5 million barrels per day. And yes, there was a lot of oil going into storage here in the United States, but a lot of it was landlocked, right, because the refiners can't process the right type of crude. So globally, looking at everything from a global perspective, this enormous supply glut wasn't really a supply glut. The U.S. was still importing mass amounts of oil. I actually saw an article from one of my friends, Steve St. Angelo. He covers the oil market too, and he said, despite the U.S.'s saber rattling, they're still importing enormous amounts of oil from Russia.
Oh, yeah, and we're probably importing it from anywhere we can get it. We still import over 7 million barrels a day. I think a lot of people think we're a net exporter now, but we're not. And this is I always remind everybody when I give talks that this is an industry with some very big numbers. So you have to put all these numbers into context. When somebody says there's a glut of oil of there's 1.5 million barrels more being produced than what we need. Well, yeah, but the market consumes 95 million barrels per day of refined products. So crude oil is it's the raw material for making the refined products that we use every day: gasoline, diesel fuel, all the feedstocks, tires. It's oils in everything, just about paints. So we just keep consuming this stuff. So to say 1.5 million barrels a day is a glut in a 95 million day market, I think is a stretch of the imagination, to say the least. And I think a lot of people are just trying to talk down the price of oil. And
I agree.
Yeah,
I agree. The last time we were on, we were discussing how it was going to eventually bottom because sentiment was so negative, and we saw the rig count. I think the rig count by June of last year in 2014, I think it got up to around 1,600 globally, and then it dropped to I think around 700 now. That's a massive cut. And yes, these multi-pad drill rigs are more productive, but there was eventually going to be supply constraints due to the rig count being cut, right?
Yeah, the rig count just for oil wells in the United States, the United States, got to 1,609, and that peaked in October of last year, so not that long ago. The rig count now drilling for oil is down to like 700, and it's probably going to drop to 500. I follow a lot of companies, and they're going to continue to lay down rigs, because you hire these rigs on contracts, and you're kind of stuck with them for a while. So as they finish the wells they're on and the contracts they're on, they're going to send them back to the yard. And so, I look at a lot of companies that may have 10 rigs running today, and they're, targeting having 6 or 5 running by the summer. So I think the rig count's going to about 500 for oil wells. Now, there'll be about another 200 drilling for gas wells, but that has also come down, quite a bit. So last year, I think we got total rigs running were like 2,200, and now we're at like 900 total. So.
Yeah, and that's on the supply side. So we've seen such a low oil price where, a lot of this deep water oil production is not economic. A lot of the oil sands oil production is not economic. A lot of the shale oil production, if it wasn't hedged, a year out, 18 months out, those hedges are going to start coming off the books. I don't know how much longer most of these shale oil production companies on average hedged, but if the oil price didn't start to rise like it's been doing, those companies were in a lot of trouble, the ones who drilled on debt and when their hedges came off.
Yeah, in most of the shale plays, I mean, you can't just say it's, a certain price, $65 is the break-even price or whatever for everywhere you can drill in the United States. In some parts, you can still get a very economic well at $30 a barrel. But they're, those are the really super sweet spots of these shale plays like the Eagle Ford or Permian Basin. You probably need north of $60 to make the Bakken economic, and once you get out of the tier 1 acreage in the Permian and the Eagle Ford, I'm sure you need north of $60. So that's just a break even. And remember, I mean, this is still risky, kind of a risky business to some extent. And capital it doesn't go to the things unless it's going to make some money. So if you assume that they need a risk adjusted rate of return of 10, 15, 20%, that the investors need, then I think you're talking about $75 is where oil probably needs to get back to for us to get a steady state. Now that once things kind of got back to normal, probably could we stay in the 75, 80 range where supply and demand would stay in balance? Probably. Then you got to add in the Middle East, risk premium. Look what's going on. I mean, there a bunch of oil went offline in Libya just earlier this week. So, there's risk to supply all over the world, and that has to be taken into consideration.
Yeah, that's a good point. I expected the oil market to return to a wider trading range between about 60, 65, and about 80, 85, $90 a barrel. That's not assuming there's some geopolitical risk and a large amount of oil production comes offline, in Iraq, Iran, or somewhere like that. But these lower oil prices, I mean, in a free market, they stimulated more demand, as you talked about in some of your letters. The International Energy Agency is projecting, I think, by the end of the year that we're going to go from around 92 million barrels per day of oil consumption, and that's oil that cannot be recycled. It's not like it's copper, right, where we can just strip it out of an old house, right, and just recycle it and reuse it. And we have to go find more oil, and there has to be some type of economic incentive to go find more oil because, maybe for a little while the companies can run at a loss, but eventually these oil producers have to have some type of economic incentive to go produce at a profit. So if we're going to go start consuming, 94 million barrels per day of oil, the market just wasn't going to be able to support that at $30, $40 a barrel, which is around where we bought them, 40-something dollars a barrel.
Yeah, the forecast that I've seen is by the end of the year we'll be at 95 million barrels a day of consumed refined products. Now that's all hydrocarbon-based products. So there's some biofuel feedstock in there, and there's some NGLs in there, but crude oil makes up the bulk of that. But it just keeps going up. I mean, I showed a chart today. I spoke to a group, and if you take like a 25-year chart of oil demand, it's incredibly consistent how over that time period demand goes up 1 million to 1.5 million barrels year after year after year. That's 1 million to 1.5 million barrels per day of consumption year after year after year. And you're headed to, 2020 will be well over 100 million barrels a day of consumption. And you got to keep finding new supply because every oil well on the planet is on depletion shortly after it's brought online. These shale wells decline at incredible decline rates, and that's why I think the supply-demand situation is going to balance pretty darn quick.
Yeah, and globally each year, over 3 billion barrels per year is being consumed that has to be replaced. So, the market is just especially Wall Street, is just so short-term oriented, so myopic. But people in the oil industry, if you're you worked at some of the larger oil companies. I think you told me you worked at Hess for a long time.
Mm-hmm.
Hess obviously has to care about the short term, but long term they have to worry about replacing reserves, right? They have to worry about staying in business and replacing those reserves that they're producing.
Yeah, you're constantly, especially if you're investing in the upstream E&P companies, the main thing you want to be focused on is, are they replacing their proven reserves? Are they building proven reserves? So, there's been a lot of, Einhorn was on here the other day talking about how they're outspending their cash flow. Well, I would say, didn't Walmart outspend their cash flow when they were building zillions of stores trying to build up the Walmart chains? Of course they were. Well, if you're building your proven reserve base faster than you're building your debt, you're adding value to the equity part of your balance sheet. So, that's just the way you got to look at it. So if you're looking at he was looking at Pioneer and EOG Resources, these are aggressive growth companies, and they're just building their reserve bases really fast. And those reserves are worth something, and they're constantly targets for the larger companies. You see this in every one of these cycles, and I think we're about to see a bunch of M&A activity where some of the bigger fish start swallowing up the littler fish to gain reserves. Because if oil's cheaper on Wall Street than it is to go drill for it, well, why not go for it? And I think you got a lot of teams that are probably looking at acquisition targets right now.
Yeah, I completely agree, and we're starting to see evidence of this. We haven't seen that many bankruptcies yet for a lot of the oil producers. We saw we saw BPZ and a few other smaller not mid-tier oil producers go bankrupt, with too much debt. But we've seen companies like Oasis Petroleum and Whiting Petroleum be able to do some emergency capital raises. But do you think these guys are aggressively looking, their board of directors and management are aggressively looking to sell the company, or do you think the higher the oil price rebound recently has prevented that a little bit?
Well, actually, the M&A activity happens during the up cycle where the prices start coming up. Because when you're at the bottom for the oil prices, the sellers, unless they got the banks holding a gun to their head, do not want to do a deal at that price. They don't want to sell at $40, $45 when they think the price is going to bounce back reasonable. Now, if the banks are putting a lot of pressure on them because they're out of, they're violating their debt covenants, and so the banks are really running the companies. And the banks don't care about equity, by the way. They just want their money back, so they force these sales. But I think some of these ones, like you mentioned, Oasis, Whiting, these guys have large, very valuable acreage positions, those two in the Bakken. And especially Oasis. Oasis is like a pure play on the Bakken, and they have some outstanding acreage there. Whiting is the largest acreage holder in the Bakken with about 1 million acres, and some of it is the Whiting has drilled some of the best wells ever drilled in the Bakken. Some of it come in at 7,000 or 8,000 barrels a day. I think those two companies in particular would be very attractive targets for ExxonMobil. Their subsidiary is XTO. They have a 100% owned subsidiary called XTO that operates their Bakken stuff, and I could see those two, either one of them, merging into XTO.
That's very interesting, and we've seen evidence that the majors are starting to do acquisitions, at least not necessarily in shale oil plays, but Royal Dutch Shell just did a very big buyout of BG Group, but that looks like more of an LNG play because I think Shell wants to corner the LNG market. Because, they have that floating LNG tanker, and they just seem to want to be I guess it's really tough for the majors to replace their oil reserves as much. And a lot of them, I read the Frackers and a couple other books on fracking about the shale oil boom, and the large oil companies just seem to not really be believers in it ever, and they seem to miss a lot of the big gains in the shale plays. Yeah,
the really sweet spot acreage was taken up by these guys like EOG, Whiting, Continental Resources got a lot of stuff up there in the Bakken. And so when you really look at the big producers in some of the shale plays, they're not like the Shells and ExxonMobils. They're in these plays through their subsidiaries and stuff, but they would probably now like to, expand their position. And now you do it at the bottom, not at the top. So now these guys got a lot of cash, so they can make deals.
Yeah, I agree. I think we're definitely going to see some buyouts. We've seen some good assets I've identified. They're not in the U.S. I saw Pacific Rubialis, which has great assets in South America, and Mart Resources, which is in Nigeria. They were taken out at at low valuations, but they have quality assets and cash flow. We've seen Vanguard Natural Resources make an acquisition recently. Do you think the majors are targeting EOG or Continental, or do you think those guys will be able to stave off an acquisition?
I mean, EOG, Continental, those would be big deals. I mean, those would be major acquisitions. EOG would probably take about $50 billion. That's possible. I mean, the Exxons of the world could buy them if they wanted to. So, yeah, it would be a major, big price tag on those two for sure. One I saw yesterday, I don't know if you've ever heard of Gran Tierra. They're down in South America, and they're probably an attractive target. And they got about 20,000 barrels a day of production, which would be pretty attractive to somebody.
Yeah, Pacific Rubiales actually has an investment in Gran Tierra. Pacific Rubiales has investments in a lot of the smaller South American oil producers. So they were a mid-tier. So they just got a big takeout offer for $6 billion.
Wow.
So I want to talk about the yield plays. You cover a lot of interesting yield plays. A lot of our listeners are looking for yield in natural resources. It's very tough to find good undervalued yield plays on most of the regular stock market. Do you think the oil sector offers investors probably the best most undervalued yield plays available?
Yeah, we have about a dozen that we recommend in our high yield income portfolio. Some are small caps with with preferred stock that pays like 9-10% rate of return. Gas Star has some preferred stock. And it's got a pretty solid balance sheet, so they're in good shape. Callum Petroleum has got a preferred stock that pays about a 10% dividend yield. And by the way, both of those, their dividends are tax-free return of capital at this point. Then you got some of the upstream, MLPs. Everybody's heard of Lynn. I still like Lynn a lot. They've got a lot of their production hedged at pretty good prices. I think they're pretty stable, and I think they are an acquirer in this market. They probably got a couple $1 billion worth of liquidity. They could make a deal. Vanguard Natural Resources, you mentioned, VNR is one. Probably the best hedged upstream MLP that I've seen is Memorial Production Partners, and their symbol is MEMP. If some of you guys want to look at that, and they got a real nice asset base too. And then, the midstream companies are doing great. I mean, everybody's, talking about these upstream prices, but the midstream companies had several years of catch-up work to get done to build out their gathering systems and pipelines, and they're doing very well. People are talking about storage all the time and that the storage levels are high. Well, somebody owns that storage, and one of the companies that owns a bunch of storage is Plains All American, and so they charge fees for people storing oil in their tanks. And they own a bunch of storage tanks up at Cushing, Oklahoma, and they're getting bigger storage fees from it. So those are solid companies in the midstream area that have a long track record of growth and a long track record of increasing dividends year after year.
Yeah, the midstream, Dan, I covered MLPs, as you know, for a while at Investing Daily, but when I worked there, and the midstream ones, they have a lot more stable cash flows.
Right.
They have take-or-pay contracts. They tend to focus on the oil service area. They either build pipelines or they do oil services, maybe trucking oil or wastewater or things like that over. A company like there wasn't many companies that, just during this oil price correction that were able to raise their dividend or increase their distribution. High Crush Partners was one of them. Because of the technological gains that were used in multi-stage fracking, how there was more frac sand needed, and so much of their revenues was locked in on a long-term contract. So High Crush Partners is a really great MLP. Yeah,
High Crush Partners and Emerge Energy Services are two of the companies. Actually, it's going to end up that there's going to be about 5 frac sand companies that are going to dominate the space and almost have like a monopoly hold on this space, because what's happened in this pullback in frac sand demand is that the little guys are the ones that are getting wiped out. And there were several mines that were trying to get financing to get going, and they got their funding pulled. So in a way, I actually talked to High Crush a couple months ago, and they thought that this might actually help them in the long run, although it kind of hurts them in the short run, that they'll have more of the market share when this thing turns around. And by the way, I mean, it's just like oil. I mean, we're still going to need frac sand for a long time, and they're drilling less wells, but they're using more and more frac sand per well. So frac sand demand isn't going to go to nothing, that's for sure.
Now, the long-term ramifications for these Capex cuts. There's been over $100 billion worth of Capex cut right off the top just in the last 12 to 18 months in the oil market. I think there was over $700 billion in Capex that had been spent in the last couple of years, and now it's being down to like $550 billion approximately. What do you think are going to be the long-term ramifications for this?
Well, the bad thing is a lot of people lose their jobs, and every time you see the rig count go down, you can probably scratch out 200 jobs per rig that's laid down on average. We're going to get down to like 600 or 700 active rigs from over 2,200, and that's pretty sad. And that, it's hard to get those guys back, and that's why, even if oil jumped to $100 a barrel tomorrow, it would take a long time to mobilize the workforce and mobilize the equipment and get going. So there's this period of time that no matter what happens with the price, it isn't like you just go out and turn a valve on and just stuff comes back. There's a lot of work that has to go to get the drilling schedule back up to speed, get all your logistics, get your pipe lined out, get your drilling fluids lined out, get your people lined out. I mean, all that takes time. So, if we wait too long and the OPEC pushes this too far, you run the risk of it flipping to the other way where, a year from now we're all screaming about shortages and why aren't they going out and drilling more wells and why aren't the Saudis increasing production? And, it just goes in cycles, that's for sure.
Yeah, I think it's the media, and they tend to hype things, too much or too little. So, when things are close to a bottom, the sentiment levels were, oil's going to go to 30 or oil's going to go to 20 or oil's going to go to 10 and we're never going to see oil above 50 again. And, when you hear those types of things, that normally means the bottom is already in the market or it's very close. And then when oil was back at 140 in 2007, it was, I believe, we were hearing 150, 170, $200 a barrel. And at those prices, it would basically collapse the global economy because U.S. consumers were paying across the board, I think, $4 or $5 a gallon oil, and most people don't have the discretionary, in the middle class at least, don't have the increase in their salary and wages and savings to be able to afford those extra amount of money per month in their budgets.
Yeah, the worst case scenario is they go too far on this and it throws the fuel prices through the roof, and that kills the economy. One thing with the dollar, the spike in the U.S. dollar, which actually explains about $20 to $25 per barrel of the decline in oil prices because of the spike in the U.S. dollar. Well, that spike has hurt U.S. manufacturers trying to sell their goods overseas. So that's one thing that's kind of a drain on the economy too. But we sure as hell don't need, high fuel prices at the same time. So I just hope they don't push this too far and we can get back to a normal, steady state, which would probably be in the $75, $80 range would be great. And I think 6-8 months from now, that's where we ought to be. So.
Yeah. We've had over 100,000 jobs lost in the United States. One friend of a friend who knows a petroleum geologist in the Bakken actually said there's over 250,000 people on unpaid leave in the Bakken area. Wow. But yeah, it's pretty massive, and that's just the direct jobs. That's not even the indirect service jobs. The people who run the bars and the restaurants and the malls around those towns in the new oil boom towns.
Yeah.
But my next question has to do with the global oil market. There is some people out there who believe that the U.S. is doing these buddy deals now with Iran. They seem to be kind of in certain aspects getting friendly with Iran, allowing them some nuclear power stuff. Do you see Iran as a threat to bring on millions of barrels in oil production in the near future?
Well, if the sanctions were lifted tomorrow, yes, they could bring on probably, they have like 5 or 6 million barrels in storage right now that could come to the market relatively quickly. Now, that's not like they could just bring 5 or 6 million barrels a day and keep it there. No, that's just a total of that much that can be brought to the market. Now, the fields, they've been shut in, so it's going to take a while to ramp those back up again. Given 6 months or so, you could probably start getting another 1 million barrels a day out of Iran. But that assumes these sanctions get lifted. Now that Congress has to approve this treaty, I don't really think it's going to happen. But that's political stuff, and yes, it could. But I think the risk of that happening has significantly diminished now that the Republicans in Congress have to approve this deal.
Yeah, I don't think Iran's going to be able to increase production that much. I mean, we heard the same thing being said about Iraq, right? Once the U.S. instituted the new government, that we were going to pay for the Iraq war with barrels of oil, right? It was going to pay for itself. We heard that one, and then we also heard that Iraq was going to be able to increase production by millions of barrels per day of oil, and none of these things have happened. So, I mean, the energy markets in general, whether it's the oil market, nuclear power, they all just seem very politicized. I don't know, maybe it's the environmentalists, maybe the politicians that are getting paid by different lobbying groups or whatever from coal or corn ethanol or whatever. It just doesn't seem like it's a free market. Like there's always, political backroom deals going on behind the scenes.
Well, I think analysts just don't understand how difficult it is to bring another million barrels of production online. Number one, how expensive it is. But you got to drill wells, you got to complete wells, you got to hook up pipelines, you have to have storage facilities, you have transportation arrangements, you got to have all this stuff. Just the logistics of that is incredible. I mean, 1 million barrels a day is a lot of fluid, and it's a lot of, kind of hazardous, flammable fluid. And so everything has to be, put into context again with what they're talking about. And you hear some of these analysts, and it's just ridiculous, the stuff coming out of their mouths of what can happen. And so I don't know. It just takes a while to build up, and it's bad if you get production going in the wrong way. And I can tell you, I think U.S. production I think it's falling today, and I think the rate of it falling is going to increase. And all this talk about the U.S. being energy independent is going to totally evaporate, because you're going to be going from 9.2 million barrels a day of production today to probably a year from now being closer to 8 million barrels a day of production.
So you think then that the shale boom has basically turned almost into a bust, or it's close to peaking?
Yeah. No, I don't think it's a bust, but I mean, it's again, once the decline starts, it's going to take a monumental effort to reverse the decline, and it's going to take a monumental amount of money to reverse the decline. Like you said, there's hundreds of billions of dollars of capital been taken out. Well, you've got to convince that hundreds of millions of dollars of capital to come back in and reinvest in the industry again. And to do that, it's going to take a very attractive price. They're going to have to believe that the price is going to stay high for a while before that happens. These turns, think about the turn of the curve doesn't happen real quick. So.
Yeah, one of my friends is a hedge fund manager, Dan, Dave Scarica, if you want to go listen to the interview on our YouTube channel or on our website. And he was looking at the Midwestern banks that have financed some of these shale oil producers, and he said, they have bad loans on their books. They don't have really any loan loss reserves, and he said most of these Midwestern banks haven't written off any of their debt. So there's a lot of debt tied to the shale oil companies. So if the oil price didn't start to go back up, or it doesn't go a little bit higher and stays there, these banks are going to have potential bankruptcies in the near future when they start taking write-downs, and they haven't raised capital either to protect themselves from the loan losses.
Well, most of the companies that I follow, even though the economics of drilling new wells doesn't look real good, the wells they've already drilled, where they're still getting $50, $60 a barrel for their oil, the cash flow from those wells is still pretty good. I mean, the cash lifting costs, lease operating expenses, and production taxes are your two main expenses once you get a well online. And those usually they're running in the 10, 12, at the high end you'd be at $15 per barrel. So if you're getting $50 per barrel for your oil that you're selling now, you still have $35 per barrel cash flow. Well, you can continue to service your debt for for a long time. As long as those wells, don't go on completion, but as long as your depletion rate isn't too high, but you've got to eventually, reinvest some of that money to keep your production up and keep your reserves from all depleting. But so the banks seem to be working pretty well with the companies. I know a lot of the companies I follow have actually been able to issue more equity at pretty reasonable prices. Oasis issued more equity. I think Whiting issued more equity. So they've shored up their balance sheet a little bit. Now, yeah, some of the really little ones that don't have much production, I think they're the ones that are most in trouble. They're not your household names, though.
At these oil prices, I think we're above $60 a barrel today.
Okay.
Do you think deepwater oil companies, the service company, the deepwater drill rig operators, the deepwater producers, do you think those are good marginal plays, or do you think the oil price might not be able to stay high enough to support some of these?
Well, I think the oil price is going to come back to support them. The offshore people think much more long term. So you don't see them canceling projects where they already have, tens and hundreds of millions of dollars invested in these projects. They're going to go forward and complete these projects. We have some pretty big producing platforms coming online in the Gulf of Mexico this year that'll add a couple 100,000 barrels a day. But yeah, I mean, I don't really follow the offshore drillers that closely, but I think some of these guys like Seadrill and let's see, Ensco, they may be pretty good. I just haven't looked at them in a while. So
there's been a lot of insider buying from Diamond Offshore Drilling. So we've seen a lot of insider buying from some of these deep water companies. So I'm guessing they're starting to feel the market has bottomed and the market sold off their stock too much. We're starting to see, actually, I think, Dan, the oil industry, to add more cases here to why there's good undervalued yield plays and good valuations here, especially at a higher oil price. There's a lot of insider buying from people, in these oil companies. My business partner, John Manfreda, wrote an article about this for oilprice.com about the insider buying. We're not seeing these levels of insider buying in other industries. So there's actually the insiders of a number of these companies actually think their stock is cheap.
Yeah. Oh, I tell you, they were very oversold at the end of the year. Our mid-cap portfolio is now up about 25% year to date because they were so grossly oversold at the end of the year. And yeah, I think a lot of the insider buying that you're seeing now is a little dated, probably from a few months ago. So yeah, they just thought their stock was ridiculously cheap. It was the best place for them to invest money personally, and it shows them confidence in their businesses. So.
Yeah, I mean, besides some of the gold and silver miners, which are higher risk and running a mine is harder, those have really good valuations too. But oil provides more cash flow, more yield. So I really like the oil industry for diversification purposes, especially because oil is used a lot more globally, a lot more common. Most people are recognized for it than gold or silver. My last question for you, though, is about the oil industry in general. Where do you think, based on someone's risk tolerance, are good places where people should put money to work in oil investing right now?
Well, I wrote in the newsletter that we just published this week that I think one of the real winners in this could be natural gas. I think natural gas prices could really firm up later this year, and I think heading into 2016 could be real good for the gas companies. I would take a hard look. I think Range Resources is my number one pick on the natural gas companies. I just started looking at Gulfport today. Is just an outstanding growth story. Gulfport Energy, you might want to take a look at that one. And then, I think some of these mid-cap companies that have good, solid production, they're going to survive. They can hunker down for a while and get through this. And on the back end, those are the wins where you can get the doubles and triples on your investment. If you go back to the 2008, 2009 time frame, they had several companies that just went up, 1,000%. I mean, Gulfport itself went up over 1,000% during the last cycle, from the low to its high. And Denbury's another name with solid, long-term domestic oil reserves. Those are the guys that you can pick up on the cheap now, that if you're a long-term player, and a year from now you could be very happy you did.
Yeah, I think there's a lot of potential for people who are looking for yield, safe yield with maybe a little bit of capital gains, investors like that, or there's also potential for large capital gains too. So it just depends, I guess, on people's risk tolerance and how much capital they have available and how much capital they want to put to work in the oil industry. But there's a lot of compelling valuations there for a lot of different types of investors. Yep. Well, Dan, I just want to thank you again for your time. I really enjoy our chats every couple months on the oil and gas industry. I learn a lot on every single one. Please tell our listeners more about the Energy Prospectus Group.
Well, the Energy Prospectus Group, we formed it in 2001, but we take really hard looks at small and mid-cap, primarily E&P companies, but we also look at several of the midstream MLPs, sometimes the drillers, sometimes other oil field service firms. But we're really looking for companies that we believe are just grossly undervalued. And this market, because some of these smaller companies are not covered as closely by the analysts, I think they get lost in the shuffle, and sometimes you can really find some diamonds in the rough. And we've had good luck in finding some of them that have really made great gains for us. I mean, Gulfport's a perfect example. I think since we recommended it, it's up like 350%. But right now, there's a lot of good value out there, and in fact, we're getting ready to publish reports on several companies. One I just finished doing a report on is SM Energy, and it really looks good. You can find more about the Energy Prospectus Group by just going to just www.energyprospectus.com, and that's our website. And you can join. It's $350 a year to be a subscriber, but there's a place you can click to see the benefits of membership, and it tells you everything you get as a member.
Yeah, I get your newsletter. It's a very valuable source of information. And if you're a hedge fund manager or an individual investor, if you're looking to put money to work in the oil industry, you provide great insights in there, especially on American companies. I just want to thank you again for your time, Dan. You do great work, and I enjoy our discussions. Please come back on again soon.
All right. Thanks a lot.